let's go ahead and get started. I'm Rochelle Wilhide. I'm the designated broker of Best Choice Realty. And today we are very fortunate to have a guest speaker who is joining us, and a little background so I get to know her a little bit more. Her name is Joanna Mummert, and she's a financial planner advisor. And a few things about her before she gets started. She has been doing this financial type of work for about 20 years. So we have a little bit in common. I'm obviously over 20 years in real estate. So we caught up on some of the inner workings of what happened in 2008 and all of the changes that, as far as planning and things like that. She definitely has a lot of experience with financial planning. Her company is Alpha Omega Wealth, and she's on the east side. So those of you that are Bellevue, Issaquah, east side, like meaning Bellevue area, she's over there as well, but she's doing a lot of her appointments virtual. So I'm sure if you have questions outside of this meeting, she's happy to spend some time with you on that. She's very passionate about Washington and the finances and how to really kind of get the most out of your money. And I think a few little fun trivia things about her is she has traveled South America, and she loves ballroom dancing. Some of you may love that she's a cha-cha dancer. She likes rumba. She did a documentary in 2009, which is, if you Googled her, you probably would find out about a documentary too. So with that, I will turn the time over to Joanna for the presentation. It's very short, she said. So there is time for us to ask questions. I know I have questions, Joanna, so be sure. We will keep the line muted while you talk. And we are recording this. So if you miss something, you certainly can send a quick little note in the chat, or at the very end, we can open the lines to ask some questions. So with that, Joanna, I'll turn it over to you.
Perfect. Thank you so much, Rochelle. It is such a pleasure to be with you all. We're still in a virtual world, and so it's been quite a wild ride the last year and a half. But one of the things I like about being virtual is that we can reach more people. So again, thank you so much, Rochelle, for having me today as your guest speaker. So today I want to talk to you about what you need to know about the Washington Cares Fund. So probably by now, because it's been something that's been coming up a lot more in conversation and on news radio, is that there is something coming in the works for 2022. And I always like to start my presentations with my little disclaimer explaining that this is really for educational purposes. It's based on information that I have collected from multiple sources, but the primary source is from the Department of Social and Health Services and the Employment Security Department of Washington. So the bill in its entirety, if you want to learn more and really get into the law the way it's written, everyone's welcome to do that. It is public information, but I have found that it's so much easier to listen to somebody else talk about it, because there are so many different nuances that are can be a little bit confusing. So one of the things that has been coming up more recently, I would say, and is the need for long-term care. So I don't know if or how many of you have aging parents or grandparents, but one of the things that I personally noticed is that my grandmother, who spent 10 years in assisted living, she needed a lot of extra care. She spent 10 years there. My grandfather was in for about 6 before he passed away. And guess what? Long-term care is expensive. It's not covered by Medicaid or other health insurance plans. And so how do people fund their care, those services? Well, through their assets that they've saved up over their lifetime, but sometimes from family members that have to support them. And a lot of times family members will leave the workforce to care for their loved ones. So currently, the average cost for in-home care is $24,000 a year. Well, that's for in-home care. The cost of nursing home care is a lot more. And so the average is about $65,000 a year. So it's not a cheap service, and of course can vary depending on the level of care someone needs. And the other issue with this rising need is just recognizing that about 7 in 10 people will need to have long-term care services in their lifetime. So it's not something that we can just kind of poo-poo and say, oh, I won't need that, because many of us will need some sort of assistance as we reach the golden years. So Washington State recognized this growing need, and they came up with something that has been called the Washington Cares Fund. So this is Washington State's solution to the increasing need for long-term care services. So again, I'm not a representative of the state, but I think it's really important to hear from someone who understands the inner workings of long-term care industry and kind of how that's insurance industry and how this all kind of fits together. So guess what? Washington State happens to be the first in the nation to come up with a plan to cover long-term care services. So you better believe that the rest of the country is focused on how we're doing things, and they are finding all the little areas where we have room for improvement. So if you're talking to somebody who's not in Washington State, California particularly is probably next on the list for implementing something like this. So when we're talking about Washington Cares Fund and the Washington State solution to funding this need for long-term care, what does that look like? How would these services get funded? Where does the money come from? Well, it's going to come from people in the workforce. So in January of 2022, which will be here before we know it, will be a new payroll tax. And this payroll tax will be assessed on gross W-2 income. So gross W-2 income is basically that top level income, okay? And I'll talk a little bit more about that in a moment, but it's going to be off of gross W-2 income. It's for employees that are based and live in Washington State. You have to be 18 years or older. So think about that. And if you're 18, it's going to be a career spanning tax because there's no end in sight. When it ends is when you retire. So it's essentially for those employed years. The current tax rate is set at 0.58%. So it's less than 1%. And gross income, here's the kicker. Gross income includes everything beyond that earned income to also stock bonuses, unpaid vacation, unpaid sick leave. So it's all of the income received on a W-2. There's no cap on income. Self-employed individuals, on the other hand, including independent contractors, are not automatically included. So let's go over some of the benefits and restrictions. And this will give you a better idea of what's this money going to buy. So we have to kind of have a good feel for what the plan offers to make a decision if it's going to be a good plan for you or not. So the maximum lifetime benefit is $36,500. So just kind of think about that in terms of what I said a few slides ago about the average annual cost of care. So if the average in-home long-term care expense is about $24,000, then $36,500 will cover over a year that cost. Or if you're living in an assisted living or a nursing home facility, $36,500 will cover maybe about half a year, right? So it's important to kind of keep it in mind with what's the maximum benefit with what's the actual need, right? Nobody knows what they're going to need, but it's a good benchmark to kind of be able to evaluate the options. Recipients must reside in Washington State and be fully vested in the program. So I'll talk about that also a little bit in the future here. But there is a list of activities of daily living. All people ask me all the time, well, okay, so how do I qualify? If I want to tap into the $36,500 of benefit, how can I get my hands on that? Well, you have to be eligible by being unable to complete 3 out of 10 activities of daily living. And I didn't list those out because they're on the website that I'll give you later, but it's 3 out of 10. So to give you an idea, an activity of daily living is like toileting, transferring, eating, bathing, so self-care, and cognitive impairment would be one of those 10. So at 3 out of the 10 is what would qualify someone to start receiving benefits of the $36,500 total. One of the positives, or could be a positive, is the fact that there are no underwriting requirements, which means that, you're not underwriting to be approved for the plan, you're just in. If you reside in Washington State and have been paying in for the vesting schedule, which is 10 years. So there's a 10-year vesting schedule, which is a long span of time where you have to be paying in before you can use any of the benefit. You cannot have a break of 5 years or more within that 10-year period of time, otherwise you're disqualified. So for someone who is maybe approaching retirement and that's going to be happening sooner than 10 years, they won't be fully vested. Benefits are not portable. So if you do not reside in Washington State, if you, for example, go and retire into Arizona or some other place where it's hot all year round, then you forfeit your entire benefit and you forfeit every tax you paid into the plan. So you can't take a benefit with you. You have to be in Washington State to be able to use it. The maximum is $36,500, and you have to pay in for 10 years before you are fully vested. It is a use it or lose it plan. So if you pass away without ever needing long-term care, that's it. You didn't get to use the benefit. If you do use the benefit because you are qualified with at least 3 out of the 10, the way that the program works is that the Washington Cares Fund, that would be administered by the different state departments handling each of the responsibilities, they would actually issue checks on your behalf to the care providers. We call that a reimbursement plan because you're not, or the recipient is not directly receiving a check, but you would have to, as a recipient, submit paperwork saying that you've been receiving long-term care services, here's the invoice or the bill, and then there's some administrative process that goes along with it to have those bills paid on your behalf. So the last thing I have on here is important to note, and that is that cognitive impairment does not qualify on its own. And I have that kind of on its own little point of importance, because if you know of anyone who has Alzheimer's disease or has major cognitive issues, a lot of times you can still a lot of times they can still be fully functional and take care of themselves in terms of bathing and eating and transferring and doing a lot of those things to take care of themselves, but their mental capacity is what is getting in the way of their standard of living and being able to fully take care of themselves. Well, for the Washington plan, cognitive impairment would have to be one of the 3. So there'd have to still be 2 other activities of daily living that someone cannot perform in order to be eligible. So those are some important things to note. One other thing about the note here where I said no underwriting requirements. That could be a positive thing for someone who perhaps would be otherwise uninsurable. So if you went to the marketplace to buy your own long-term care insurance plan and you had some existing condition that would prevent you from being eligible for a plan or would make it really, really expensive, that doesn't apply here. There's no underwriting. So those are some of the benefits and restrictions. And I want to take a deeper look at what the tax rate looks like. So how the tax calculates out. And also, I think probably something that I think is the most important, and that's that benefits are not guaranteed. So the current rate of the tax is, as I mentioned, 0.58%. So that equates to 58 cents of tax per $100 of income. So on an earned income or a gross income of $100,000, someone's tax bill would be $580 for the entire year. Now, one thing that I want to mention is that is going to be the responsibility is going to be on the employer to be taking out the payroll deduction for the tax, and I believe it's going to be paid. It's going to be coming out of every paycheck. So that is something that's going to be the responsibility of the employer, but it's going to come out of the employee's paycheck. So the if someone earns $250,000 in gross income, their tax would equal $1,450 for the year. The tax rate itself is subject to increases. So the way the law is written, and I've read over it a few times, let me tell you. I've been looking for all the little loopholes just in case there's something that I'm missing. And it can be changed. So in my years of experience of understanding finance and how money works, because it's something that I'm super passionate about, when you look at the way that the bill is written, it is very explicit in the fact that there is room every 2 years. The state of Washington has independent teams that are actuaries who basically understand how to calculate how much money has to be in a program, the rate to fund it, to keep it feasible, and to keep the plan alive. And so every 2 years, they can make the decision to change the tax rate if it's needed to keep the plan feasible. So that's one thing to be aware of. It can go up. And some actuaries have already told me that the rate should actually be closer to 66 cents per $100 of earnings rather than the 58 cents. So honestly, it's probably already too low. That's an opinion. And then the other thing is that they've also written in the law that the maximum lifetime benefit can also be adjusted. So think about what that means. If someone's making a long-term plan, assuming that those $36,500 is set aside for use in older years, that amount can actually go down. It could be raised too if they've got that room in there, but the money has to come from somewhere. So it's not set in stone and it's not guaranteed. Go in with your eyes wide open and understanding that. I think it's very key to know that that's the case. Good news. So if you don't think, after really evaluating your situation, or if your clients, anybody who lives in Washington has an opportunity right now, and that is that employees have a limited window of time. And when I say limited, I mean it's short, and we're going to talk about that, to permanently opt out. So the key word there is permanently. because if someone chooses to opt out of the state program, that's it. They are forever out. On the flip side, self-employed individuals, so sole proprietors, number 7 LLC, independent contractors, are not automatically included from the plan. They're actually excluded from the plan, but they can choose to opt in. Okay, so not automatically included, but they do have the option to opt in if they want to. Here is an important timeline. So when I say short time, I'm talking really short. So the law was signed, the bill was signed into law in May of 2019, which when I first found this out, I was pretty much shocked because I hadn't heard about it. So the bill was signed into law in May, but we are now in a period of time where if people choose to opt out, they have they can start to opt out or start the opt-out process October 1st of this year. So I've already requested the opt-out application multiple times from the Office of the Employment Security Office, and I have not seen it yet. So I think that they are kind of a little bit backlogged on things right now, but the application should be available October 1st. Now, in order to opt out, so basically, in order to say, okay, I don't want to pay this tax, I choose not to, and I want to permanently not pay this tax, you have to have alternate private insurance coverage in place. So one of the things I tell my clients is if you don't have long-term care insurance now, you're going to pay for it one way or another. So come January of 2022, you're going to have it. So you just need to make the decision which way you want to go. And so the deadline again, so October 31st is when you would need to have private insurance in place in order to opt out. So that means between now and October, and then you'd have to have something else some existing plan in place that would make you eligible. And there is a list of what is eligible coverage. And then you have until all of next year, December 31st of next year, when the period ends. But really, that timeline is a benefit for people who had coverage in place. So maybe someone who's moving in from out of state already had long-term care coverage. They can still opt out next year as long as they had a plan dated prior to November 1st. So if you're already in Washington and you want to opt out of the tax, you need to make sure that you get something else in place ASAP. The washingtoncares.wa.gov website is a resource that's basically the Washington's, that's their website for information. It's a good resource, and also where people are going to need to go for the opt-out application, and also for the opt-in application if people choose to do that. And I'm sorry, I forgot to put that on my slide, but beginning January 1st of 2022 is when independent contractors, sole proprietors, etc., can start to opt in if they choose to. So let's switch gears and follow this path about, okay, I want to opt out. How do I do that? What do I need to do? I was talking to some of my clients just the other day who were saying, Joanna, if I didn't have you to talk to, I would have just ended up paying the tax because I didn't know what else to do. I would have just said, okay, there goes the money. So I think a lot of people might start seeing that happen because paychecks are going to come and there's going to be some money missing, and they're going to say, where did my money go? So in order to kind of take a little bit of control of the situation, if you want to make a decision about which direction you want to go, let's look at the options. So there are 3 ways that you can opt out. And the first is group long-term care insurance. That is usually offered through an employer. So it's a group plan, which means it's group underwriting, and it's pretty easy. You just kind of opt in and start paying the premiums to get coverage. I'm not going to spend too much time talking about that, but it's something that basically if someone's interested in that option, they have to first find out through their HR department if it's even offered. So the standalone long-term care policy is really the area where you as an individual have more control. Each policy is individually underwritten, which means if an applicant has excellent health, that's going to help their health rating, which helps the cost. It's going to be based on age and lifestyle. Benefits are usually paid to a maximum dollar amount, so it could be a lifetime benefit. So kind of like the state plan is $36,500. You could purchase an individual plan that's going to also have a maximum dollar amount, and they're usually a lot higher than the state amount. You can also choose a number of months that you want to have coverage coming in. There are discounts for couples who apply together. I'll give you one piece of information that's kind of an update to this slide, and that is the fact that there has been overwhelming demand in the state of Washington for private insurance, to the point where some companies, I heard, were getting 5,000 applications a week. And so guess what? A lot of companies have already started suspending sales for standalone policies. I can provide a lot more information on that if you have specific questions. So, supply and demand. And the last of the three options is what is called a hybrid long-term care policy. And that is also going to be something that's individually underwritten. So you get benefits, you get a benefit if there's, the younger you are, the cheaper it tends to be. And also health is going to play a major role in the cost of something like that, of this type of policy. Benefits are also paid monthly to a maximum dollar amount, or it can be for a lifetime. Now this is the big benefit that I personally like about this option, and that's that unused funds can be left to policy beneficiaries as a death benefit. Essentially, a hybrid policy is using a life insurance contract with a long-term care rider. Okay, it's a very specific type that is designed and created by the insurance companies to fund for long-term care insurance, but there is a death benefit that is kind of built in. So it is not a use it or lose it type of a policy. There's also optional features that can be added on to enhance benefits, such as inflation. You can add a cost of living adjustment to your benefit amount. And then also shared benefits can lower the cost and keep the cost down. So I wanted to give kind of an overall, like a bird's eye view of the options here, and to wrap up with some food for thought. And I think probably, especially just from the agents that I know that are with your organization, you're always looking to help people, looking to really offer something of value to your clients. So I want to be a source of information for you. Please feel free to email me or call me or text me. Allow me to be that partner for you to answer questions and to really be a resource. So how can you use this information to be of value to your clients? How many people will just pay the tax because they don't understand what their options are? And also think about young people entering the workforce may not consider the long-term impact of staying in the plan. I mean, the younger they are, the more years they're going to pay into this. They could end up paying in more than the benefit they would ever receive. So time is of the essence because, as I mentioned, insurance companies are facing overwhelming demand. So I basically have just been telling everyone, don't wait. If you want assistance, if you want help evaluating options, don't wait because you may run out of a chance to make that kind of a decision and choose something different. So I'm Joanna. I put my phone number and my email address on the screen. Jot it down. You will not bother me even if you're texting or emailing in the middle of the night because I have been working around the clock while this has been happening. And I love it. So it doesn't bother me at all. My clients are like, I got a message from you at 10 o'clock. I'm like, I'm just getting started. Yeah. So thank you. I want to open up for questions. I just realized I did talk way longer than I was expecting to, but
you were right at 6 o'clock, 6:02.
Well, hey, perfect.
I know.
So you probably, I mean, I'm sure some of your listeners have questions.
We do have a couple questions.
Okay.
Yeah, so how much in terms of percentage is projected in overhead to implement and manage the plan? And how much in terms of percentage is projected to go to the beneficiaries?
So, okay, I'm not sure if I understand the question entirely. So let me try and answer it this way. So let me back up. Every plan is going to be different based on the person who's applying. Right. So I mean, it's impossible to answer that with a broad stroke, right? Because it's going to be based on so many different things. But one of the things that I have noticed for clients when we're looking at the options is that if you look at the amount of time paid in, the death benefit, like the money that's the money that's set aside, what we call the long-term care pool, mm-hmm. is a lot more than someone who's paid in.
Right.
So really it's offering the protection to cover the risk of needing the long-term care coverage, needing those services, right? Mm-hmm. So, but if you've got that net, that safety net, that if you don't need coverage, like if you don't need long-term care services, you're not going to spend through, let's say, $150,000 of your long-term care pool, then you have $150,000 of death benefit that will be left behind. So it depends on the amount of coverage you want to purchase. That's going to affect the price. But
self, right? As far as that goes.
Yeah. So there's a lot of different pieces to that, but there is absolutely value to a plan that is allowing you to either use it or leave it to your heirs. Because you're not just wasting, it's not money wasted, it's money that's kind of set aside.
Okay. So this is rapid fire. This is just
okay, go get to it.
Is opt out for W-2 employees only. So that's the opt out clause.
So I'll tell you this. So technically, those are the ones that are going to be automatically enrolled, right? But here's again food for thought. If at any point in the future someone plans to become a W-2 employee and have earned income, that's going to affect.
Right.
You're going to pay the tax. If you don't opt out now, you're going to pay the tax. So anybody younger than 18 is going to pay this tax for their entire career in Washington State. Now, I will say also kind of along those same lines, sole proprietors and independent contractors, if they choose to opt in, the tax would be paid on net earnings or if you take a salary from your business. So if you are incorporated and receive a payment from your own business, then you would essentially be collecting the W-2 income. So you would owe it on that. And that way you would be automatically enrolled. So I'm telling pretty much anyone who, I always say, talk to your accountant, right? Because I'm not an attorney, I'm not a tax accountant, but talk to the tax accountant or your tax specialist to understand how much tax you would pay. but talk to a professional who understands insurance to be able to evaluate the options. And then you can kind of see, but because the taxes are one thing that's, I think a lot of people are going to be trying to figure out how much, what's their actual tax going to be.
Okay. And then Terry said, does this apply to people on Social Security, and do self-employed need to get that permanent opt-out on the off chance that they become W-2s in the future?
That's such a good question. So I'm going to go back to this of, okay, so Social Security income does not count towards it. Okay, so it's not like double dipping in that sense. But if someone is like self-employed now and thinking that maybe they're going to be receiving some sort of W-2 income in the future, I'd opt out because you're gonna pay for it. Well, I'm saying opt out, but honestly, like I said, I want to back up and not say a blanket statement for everybody, because it really depends on an individual person's situation. And it's something that you want to take seriously and actually consider the options before making a decision. Because
so it sounds to me like I guess my mom is a perfect example of that.
yes.
My dad passed away.
Mm-hmm.
She was on Social Security. She was not in the workforce. She's now in the workforce now.
Mm-hmm.
So she's W-2.
Yes.
She's kind of in that pool to answer that question, where
right.
she should probably sit down with a financial advisor
right.
and CPA to make sure that she, maybe
right.
take the Social Security and she's, gets the proper insurance. I don't know. She's kind of in a tough position.
Yeah, too. And because you have to look too and see how much someone's income is, because they'd have to pay into this for 10 years to be vested.
Right.
So if
my mom going to live for 10 years.
Right. Exactly. And so it may not make sense to opt out. And also, again, depending on someone's age, it might long-term care insurance, depending on how long they've waited to get something in place, it could be really expensive for them. And so it may not make sense. Right. But one of the other important things too to note is that the options are not mutually exclusive. So somebody could theoretically have private insurance and pay the tax and have this be part of the state plan as well. That's not going to exclude you. So I always say the more you have, the better, right? Because then you have more protection. Yeah. But I think the main concern that I've had a lot of people come to me with is my income is increasing, and this is going to be a hefty tax on something that I'm going to pay into for a long period of time, where I don't know what the value is going to be that I'm going to receive from it. I may retire out of state. I know. There's way too many unknowns. I'm going to be paying $24,000 into something where I'm only going to get a little bit more out of it. How would you leverage the same amount of money that you would have spent towards the state plan into a private plan? You can leverage it much more efficiently and have a benefit that would last your lifetime.
What does that run after, Joanna? Yeah, you're answering the question.
Yeah, so the cost, again, it's almost impossible to say because it depends. I mean, I have some people that have come to me and say, what is the absolute cheapest plan I can get? Right. And I'll say, well, how old are you? And how does this look? Because it depends. It really depends. And do you want to get quality, or do you want to get something that's just going to get you out of the tax? Okay. And I'm sorry, you've got more questions, so I'll stop for a second so you can ask. You're doing a great job of rapid fire. There are a lot that are coming in right now. Carriers they should reach out to for a private plan. Do you have a list of some that you can maybe provide us? I'll tell you that there's the list. There is a list on the Washington State Office of the Insurance Commissioner. Okay. Of companies that offer plans, and like I said, use me as a resource too, because a lot of those companies have suspended sales and you can't even get plans from them anymore. And some companies you have to go direct with. So it's a little bit muddy. Sometimes the waters are a little bit muddy sometimes in terms of kind of navigating where to go. but there are still options as to which companies you can go with. I'll tell you, some companies have already started raising the minimums.
Okay.
So for example, John Hancock says, okay, our minimum is no longer $100,000 of long-term care pool. It now needs to be $250,000. What does that look like? So these are things that someone who's like doing this every day is going to know and be able to say, okay, let's look at your personal situation. Okay, let's direct you in the right place. Because it's a moving target right now.
Sounds like crazy. And then
It's a moving target.
One of the biggest benefits that I'm seeing, and what you echoed as well, is that with the private plans, it does allow you to move to different states. And
right.
This is something that is mandated in other states. We're the only one.
Yes.
I think a few people jumped in later on our
right.
call. So this is Washington State that's mandating this type of long-term care, where 49 states don't. We're kind of leading the charge, if you will, through this. Is that correct?
Exactly.
So the private plans allow you to move between states and keep your plan, correct?
Yes, absolutely. Okay. Absolutely. And there's so many different designs too that can be created. The youngest person I'm doing a policy for is 21, but I think they can actually go down to 18. That can change. That can change, because I saw one company that I work with change the minimum from 30 to 40.
Wow.
So again,
they just jump on it. It sounds like
I just keep going back to that idea of don't wait, because things are changing on a constant basis. One other thing too that I think is important to note here is that as it stands, there's nothing in place to basically provide recertification, meaning that once somebody gets an approval for an opt-out, you would receive a letter that you've opted out of the plan. It is your responsibility to retain the letter and present it to any future employee. So the one thing that has been discussed is, well, what if I just decide I don't want coverage anymore and I let it lapse? Well, there's been talk that there's going to be calls for recertification, which means you would have to show the policy, every couple of years or so. But it still has to be dated prior to November 1st of 2021. And that's the key is, you can opt out next year. Just make sure it's dated correctly.
I see. Okay. I think that's pretty good. A lot of people answering other people's questions, which is great to see.
Awesome.
And I think we're just wrapped up on time. Health insurance also, they need to start thinking about that as well.
Oh my gosh. Yeah. Health insurance, Medicaid doesn't cover long-term care insurance. And so it's very specific. If you have existing life insurance too, probably doesn't include a long-term care rider. The law is very specific for the state of Washington in terms of what will be qualified coverage to have in place.
Wonderful. So, well, I think we covered a lot of ground, Joanna.
Yes, we did.
Good job. And just take down her phone number and email address, you guys. I think that was very well worth my time, especially. I think I can speak for everybody here on this call. I think we took a lot of notes from your insight, and I think we'll get some follow-ups out of this. Thanks again, Joanna. Have a great week, you guys.
Thank you so much.